$51 a barrel. Markus Helsing from AlphaBroking, live in our Melbourne studio. Markus, warm welcome to the show. May the 25th, it might seem far off now, but already positioning occurring on what is said to be a crucial rollover or not meeting for OPEC. Between now and then, other factors that are grabbing your attention?
Well, yes, hi, how are you going? Look, for us, really, the natural gas market is way ahead of the oil market in itself, and is actually the energy market we get quite excited about. I mean, if you look at the technical fundamentals and where we are in pricing, natural gas to us is the stuff we get excited about. We're long, we're loving it. I think that's where the focus should be in a moment. Oil, we look at West Texas Intermediate just below $51. We just find while the global inventories start to come off from extreme highs, they're still very, very high. So we expect OPEC to resume their reduced OPEC policy, to hope to bring these inventories more into line, probably by the third quarter this year, to levels where they can seriously start to expect some price movement. In the meantime, we think there's a very fair risk with oil, speaking of West Texas Intermediate, to have one more fallback towards $45 a barrel, even a bit lower. And you'd find a lot of hedge funds, a lot of consuming main industrial companies would be putting their hedges right in at $45 and below. So I reckon one more major pullback would be extremely supportive.
When you're watching the build in rigs coming out of Texas, what do you believe to be the strategy at play here with that push-pull with shale far from out for the count, very much, you know, looking as if it's taking the game on to OPEC?
So you just worded it rightly up. I mean, really, they are smart operators, and whoever is there and has the liquidity and cash flow to rock and roll, so to say, I think they're well equipped to benefit down the track from higher prices, and they will be there. I think this is now really a price level of $60 plus, where you can see some serious action out of the US in terms of the rig counts. Until then, I reckon it will be just steady as she goes. But we really believe, to be honest, the whole action in oil will happen in the second half this year. In the meantime, we're looking for one more opportune buying level at lower levels in terms of oil stocks as well as physical oil. And I think that could be a brilliant setup for second half this year onwards. And you'll find rig counts, all that will go with the price.
Interesting.
It'll be higher.
Okay, well, there you have it. Meanwhile, let's talk the buying opportunities to be found amongst the gold and silver story. I mean, in light of dollar moves, crucially, where are we seeing, where are we seeing the key drivers here? Because, I mean, short term, are we talking further greenback weakness, or what's the positioning?
I think you've got to look at the US bond market, and as mentioned earlier, the general market feel out there. It feels as though equity markets might shift from a Trump run into a Trump slump. So really, we really think there's a corrective action coming in most stock indices over the next few months. Selling may and go away always comes to mind. And I mean, we had a very extended rally. So speaking of the bonds, they already built a lot of that in, and the bonds are rallying in price and falling back in yield. So ultimately, that puts the US dollar into an awkward situation. Whenever people get excited about the US dollar versus the euro or the yen, well, they have domestic yield pressures again that change the game the next day. So basically, when it comes to gold, it really needs to break your $12.60, $12.80 an ounce to get excited on the upside. We actually feel the general look in gold and silver looks, again, a lot better. But without confirming price movements on the upside, you're really talking still about range trading. I like it long term. I've got to say, I made a major shift on our macros. We looked at the inflation-deflation scenario globally, and we still believe that the biggest force out there in years to come will be a deflation risk rather than an inflation risk. So that sort of might put my long-term, very macro bull view on gold maybe on the back burner. So we are really in the moment still happily long gold stocks and gold, but we might have to shift our macro view out quite a few more years potentially.
Specifically, how many years?
Now, look, I mean, it's really, I mean, we have really, the US bond market is the boss for all financial markets, and we have now the Federal Reserve talking obviously about cutting back on their bond holdings and whatnot, and the European Central Bank will probably follow suit the next year if they're able to do so. There's a lot of ifs happening out there. I mean, we have very stretched debt levels, very stretched equity markets that can get a lot more stretched. Basically, our question is, what we ask ourselves, if we finally do see some major market disruption, is gold really a safe haven or not when we have major deflationary pressures coming up? So that's really the question to be asked, and at this point we're a bit 50-50 on that.
Dr. Copper, technically, fundamentally, stuck in something of a rut. What might see this one break to the upside? Could it be further talk of strikes as they develop potentially out of South America?
I don't think so. I mean, the latest strike action really, as we all seen, has really had bugger all of a price impact on copper. So it's really a China story and a little bit the US infrastructure plan story, but really it's a China story. In the moment, copper's done nothing wrong. I mean, had a good rally the last 6 months, 8 months. It's holding up and making a bit of a consolidating. But really, we need to see major breaks. 280 cents a pound would be tremendous for the bulls, while if 250 breaks, well, we're going back. So that is really telling us a little bit where we're at, actually. If you look at also Australia, the Aussie dollar, for example, we think the Aussie dollar is a tremendous barometer in the moment for what's happening out there. Our terms of trade are going brilliantly, and what's happening to the Aussie dollar, it's still drifting away. That's sort of building in future weakness, and that potentially could happen to copper.
It's interesting, this holding pattern that's equally applicable to a measure to Fortescue and BHP. Now, the current levels, which are not to be dismissed, I mean, they're pretty lofty. You're saying, though, it's going to be hard to cleanly break free beyond where we're sitting at the moment.
Exactly, and I think Fortescue, which is more the geared play than BHP, of course, is really a great stock to look at. And I mean, a tremendous run, I must say, it's well done. It's a company that's obviously well managed, but it's still relatively geared. But to us, really, price-wise, it shows it's run out of puff. The least you can say, it's going to correct a bit more for the time being. It doesn't look to us as though it's going to be a major sell-off coming up, but it could drift lower, and that basically tells you a bit the story about what's happening out there with iron ore, of course. That's drifting as well, and with the general industrial commodity plays.
We began this discussion, if anything, talking the fortunes of the crude pricing. For an airline like Qantas, looking to, hedge out into the future and worrying about where to next, as is always the case, what would you say looks like a smart move here for it to lock in at? I mean, now that we're at these levels?
That's a brilliant question. I mean, there's a 3/3 rule is always the one to apply in our view. Lock in 1/3 no matter what. Do the 1/3 at opportune levels and play the last third. But everyone has their own wisdom in hedge policies. But in terms of full lock-in, anything with oil price at $45 and lower a barrel in US dollar terms, to me, must be looked at very, very strongly. We think there's one more fair chance for that to happen. Conversely, if you see a $55 break on a monthly close, well, that's a must lock-in scenario no matter what, because then potentially something could be happening on a much bigger scale on the way up. It will happen in our view at some point in the next 12 months, probably just not yet.
All right, patience and watching it keenly. As always, Markus Helsing from AlphaBroking, thank you as always. We move on.